So they provide our infrastructure and ops, and these ETFs are not like traditional ETFs in that you're dealing with underlying assets that fork and there are airdrops. So it's not like the traditional equity or bond ETF. 21 Shares has been in this world for 5 years with 46 funds. They've been through booms and busts. They've been through halvings and forks and airdrops. And what I'm very proud of in terms of that part of this rollout is we have on most days the tightest spreads. And I think that surprised people and is one of the reasons we're right behind BlackRock and Fidelity.
Yeah, you're competing with the absolute giants here.
Yes.
Do you feel that there is an ability to find some alpha within the spot ETF competition? It sounds like that's what you're alluding to with the spreads.
Yes, oh yes, and it's not that it's not just alpha. It is, I think our clients understand, given the due diligence that they have done, that we are slightly differentiated from an infrastructure point of view, a place on it. And so this is just the beginning. Think about how big the internet is, how global it is, and how ubiquitous it is. The financial layer has only started.
How have you measured since the ETFs launched who's buying, and if that new buyer from either institutions or holdouts, who is behind it? Who's in the flows, and how has that informed the market cap growth, the price action of BTC?
Yeah, as you know, we can't tell who our shareholders are. Maybe at the end of the quarter we will see the largest shareholders. But the pent-up demand has been in a lot of places. Retail, it has been there because, as I mentioned, people don't want to deal with wallets and hardware and all of the friction that you have to go through to self-custody. And then on the institutional side, the SEC gave Bitcoin the green light, and so institutions understand this is a new asset class. They have been studying it, and I'll tell you why they've been studying it. In 2018, Cambridge Associate, which is a consultant to endowments and foundation advisors and asset allocators, are doing their homework. The light bulb is going on, and basically they're saying, again, they're beginning to understand that, wait a minute, this is nothing but the internet financial system rolling out. This is a big idea. And it's Bitcoin, of course, but then there are smart contracts, DeFi, decentralized finance. We're starting to use this term internet financial system. It doesn't sound as defiant. Okay. It's just technology, at work, and actually making up for lost time. The early developers were not even talking about this. In Nigeria, in June of last year, the government let the Naira, local currency, float. It's a new administration, let it float. It's an oil-rich country. We can support it. Guess what? It's lost 2/3 of its value, and the government is now detaining 2 people from Binance and is insisting, that they need to learn who has been manipulating the Naira with Bitcoin, which we don't believe that's what's going on. What we believe is there is a flight to safety. And we saw this with the regional bank crisis last year. And we had NYCB recently, again, a reverberation of the regional bank crisis. That is also macro. The deposits system-wide are still going down. The problem has not gone away. Bitcoin is an insurance party against counter. They can have their Bitcoin. Price discovery is what ETFs are known for. When in 08-09, there were bonds that were not trading. There was no price discovery. Bond holders who wanted liquidity needed to find price discovery in the ETF market and liquidity. So I think you're arguing the case for Bitcoin in the form of an ETF. enough because it's in cold storage that has not touched the internet in our case. The wallets in cold storage have not touched the internet. They are not hot.
Right.
And so the safety and security of Bitcoin.
It's pretty amazing. After talking with Ophelia last time, I mean, that's the biggest similarity to gold.
Absolutely.
But what I'm wondering is now when people are buying a fund, when I go to the ARKB page, right, on the reasons why ARKB, it says that Bitcoin is an established digital store of value. I could debate that all day on whether or not it is. It says, as you just mentioned again, that it offers diversification to a portfolio. I would argue the stats show that it is a high beta risk asset. So what I'm wondering is...
Bitcoin led, maybe by a few days, but Bitcoin took off because I remember saying during the regional, I said, wait a minute, Bitcoin's going up, what's going on here? And that's when, and I can tell you when we also saw this, when we first gained exposure to Bitcoin at $250 versus the $73,000, $74,000 now, and we believe the journey's just begun. When we took our first exposure, we were on edge every day trying to figure out, okay, how will this behave? And when Greece threatened to leave the European Union, and we got fear again in the euro of reverberation of the European sovereign debt crisis, Bitcoin went up. Bitcoin up on those days. And back then...
The stocks are rallying too.
Back in 2000 and... No, I don't think it was as clear-cut back then. No, no, it was not. So you're talking about a store of value. If you talk about robotics, energy storage, artificial intelligence, blockchain technology, multi-omic sequencing, we have never seen this kind of innovation before. And what is the other side of truly disruptive innovation is creative destruction.
Sure.
So I think this seeking safety in indexes is not going to end well.
The counter argument, of course, is that right now your ARKK fund is almost at record low relative performance to the NASDAQ at a time when arguably the biggest innovation in technology in, I don't know, what decades is happening with AI? How do you explain that to investors?
Well, I explain it because this is the flip side of what happened in the late 90s. In the late 90s, what happened? We had the internet and everybody said, oh my gosh, this, like, where's this going? This is going to the moon, right? Too much capital chased too few opportunities too soon, and it ended badly, right? It ended badly. What we're going through right now is the opposite of that. We've got everyone hugging benchmarks. They're running for the hills. They're scared. 1 year later, what happened to Cisco after it had been up 30-fold over the previous few years? It went down more than 50%. Why? Because corporations, enterprises were starting to take this internet thing seriously, and they're saying, wait a minute, this is going to demand a lot of investment, and strategically we have to get together and not just use these tools willy-nilly. We need to figure out a strategy. I think that's what's happening to AI right now. Enterprises are saying, wait a minute, this is way too important. We need to figure out how to harness AI so that we win in this competition. And as they pull back, because they know they have to integrate their data, map out workflows in excruciating detail, right? That corporations are going to pause. And I think that is going to pause everything. And maybe NVIDIA, I have no idea.